We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is James Anderson from SDBullion. James, how are you today?
I'm good, Tom. It's good to be back.
Excellent to have you as always. And I want to start by chatting a little bit about the biggest story at this point on everybody's mind. And that's the fact that we cracked $3,000 per ounce on gold last week. And this week we're recording this on March 17th, 18th. And of course, we're already, 1% above that. We're $3,025, $3,030 already in spot as we're recording this here. So how significant is this gold price and how we broke that big round number as well?
It's important. I mean, every $1,000 level nominally in the US dollar gold price is important. And typically there's a fight that goes on. It doesn't just pierce it and just keep going, right? Generally, it'll pierce it and then it'll retrace, go below it, and then you'll have a battle that goes on. And we have data that goes back. I mean, for instance, 1,000 was pierced in early 2008. And then, surprise, global financial crisis, it went from 1,000 down to 700 in gold very quickly. And I remember there were times in that time, then in the global financial crisis, working in the bullion industry where our retail dealership didn't even have any inventory for like 3 or 4 days. That's a scary thing as a bullion dealer. You basically, that's how you make your buck is to broker bullion to products to people's houses. And I remember distinctly selling a lady a kilo bar of gold at like 900 an ounce when spot was near 700 and thinking she is getting ripped off. And then, now as I sit here today, I'm sure she still has that kilo bar of gold and she's happy about it. Right. So it didn't take long from 700 back to 1,000 because we went into the infinite QE era. And so you had these battles. 2000 was a huge battle range and, Russia and then the freezing of Russian assets and moving off 2000 and it finally became support. And, you'll never see, I don't think, fiat US dollars valued less, per ounce of gold. And it's not going below 2000 anytime in our lives, I don't think. Maybe a new US dollar, there'll be a different price, but not in this format. So, yeah, the 3,000 number is important because it draws headlines. And you have media out there. Media coverage in a bull market is typical. What you see in a bull market before it becomes a bubble is a lot of positive media attention. And then you get capital inflows from institutions, which is not even close to where it was. Even in 2011, there was a lot more institutional involvement in gold and silver proxies. So now you basically have a situation where it's $3,000 gold. The media attention is positive, which is good. You're getting more flows, but it's nothing. It's nothing yet. When you'll start to see, I think, institutions moving in when you see 3,400, 3,500, and they finally realize, we have to get off the deck and get involved with the gold market or else we're going to get left behind. You have the S&P 500 divided by gold, which is like 1.88 right now. If you look at a long-term scale, it's very common for it to be 1-to-1 parity, right? And the S&P 500 is trading at like 5,700, 5,600. That's, for me, it's going to be a day, it'll come. It's just a question of how long. But gold nominally and the S&P meeting 1-to-1 is inevitable. It's going to occur again, I believe. And I believe it'll not only occur, but then we'll go even higher than the S&P 500. And if you look at long-term charts, you can see mega spikes in the early 80s and 2011. It went well below 1-to-1 parity. And so if 2011 was a bull market, just wait until you see the 2030s gold bull market and how crazy it can get. So,
well, I think that's a really important point, is to be looking at these long-term timescales and also logarithmic charts, not just linear charts, right?
Correct. Yeah, that's the other thing is people pull up charts and they look at linear charts. And so it looks scary on a linear chart because, linear charts don't take percentage into play, right? And so these nominal numbers can look scary, especially to older folks when they look at it and they think, well, gold was $300, earlier in my life, and now it's 10 times that. What a scary thing to buy into. But ultimately, what it is the currency is simply losing value to gold. And that's essentially where we are. I mean, we started at $20.67 an ounce, however long ago, and that's 140 multiples roughly to here. And so do you think that trend's going to stop? I mean, it's like, nothing structurally has been fixed. The debt is crazy. The system still needs to rejigger itself. The unipolar dominant U.S. Situation post World War II debt supercycle has not been rejiggered, and in that rejiggering, I would assume that gold is going to reassert itself as money numero uno, and in that time frame, gold was going to do very well, and silver will probably perform and play a catch up rally later on. So that's essentially what I'm looking at here is like keep it in the longer term perspective, pull the logarithmic chart out, and do a long term chart, and you'll see that on the way to 4,000, I mean, this is simply just, you'll see the hill going up on like a basis where it makes sense. Okay, 4,000, if you do the math, right? If you think from when Nixon cut the gold and the US dollar tie and basically defaulted on our sovereign trading partners in 71, from 30, well, it was like 40 some odd at that point, but it got to 1,000 about 36 and a half years later. And that was, 2008 when it got to 1,000. And then it got to 2,000 in about 12 and a half years, right? And so to get to 3,000, it took 4.5 years. And so everybody's thinking, oh, well, it'll be 4,000 by the end of 2026 then, right? I mean, everything, it seems like it's speeding up in thirds. I don't necessarily believe it. There's one caveat I think that people need to keep in mind is that the shorts on the gold side inevitably will drive this thing back toward the 200-day moving average. 200-day moving average is 2,620 some odd right now an ounce. And you have what's sitting out there is the Russia-Ukraine war. And I would assume, I would hope at some point we get a ceasefire and at least an accord and we get some peace there. And when that occurs, I would expect a massive short drive down on gold. And you'll see gold dip below 3,000 an ounce. And it'll scare a lot of people out and thinking, gold, that's the peak. That's as high as gold will ever get. Mm-hmm. But the people who think that haven't actually studied gold. The problem is that most gold has been, the history of gold has been taken out of business curriculum since the 1970s. And so most people that comment on financial markets have absolutely no idea about anything about gold. They've never done any research. They don't know anything. They're basically illiterate when it comes to gold. They don't understand why central banks are buying in record sizes in the last 3 or 4 years. They don't understand that basically the gold bullion bull market is a run to bullion over bonds. And the bond market is the biggest market in the world. So if you get flows from the bond market into bullion, that changes everything. You basically get a phase transition where all of a sudden gold reasserts itself as numero uno and bonds take a second seat. I mean, bonds were in a bull market from the 1980s until the late 2010s, right? You would expect that there are a 40-year bull market for it to have a secular bear market that goes at least 20 years, right? And so that's 2020 to 2040. I think in that time frame, you're going to see gold reassert itself and do something for the history books.
Mm-hmm. Well, James, within the last, let's say 2 months here, we've seen a lot of gold, and I want to separate at this point gold from silver. A lot of gold leave the LBMA. That got a lot of attention. Their, delivery times went way out. How has that situation, or has that situation resolved itself? And, why do you think that we saw all of this physical delivery or entities standing for physical delivery?
So there's been a large drawdown of silver out of London since December of last year. There's been over 100 million ounces that's inflowed into the COMEX side of the equation. So it's all come stateside, kind of like the gold flows happened. Mm-hmm. You have Bloomberg today who published an article headline, Global Silver Market Under Strain as Tariffs Trigger Dislocation. So they're still running with the tariff reason as why this is occurring. They then post silver lease rate soars as tariff risks expose tight market. They have spikes in the silver lease rate at 6%. I'm sure it's higher than that if you actually go and look at the data. But it's what you see is a lot of people who've been in this industry at the heads of desks of bullion banks like Robert Gottlieb. He was a managing director at JP Morgan in the precious metals desk. And he was at Bear Stearns before when it collapsed in 2008. He went on to JP Morgan. I mean, he's been commenting on LinkedIn constantly about the lease rates in London. That's the key to stay focused on is what's going on in terms of the lease rates in London. And when the lease rates are spiking, what that signals is that London's just doesn't have enough silver. And so they're trying to attract silver to come back to their market and to borrow it at a high lease rate. And then, hopefully whoever lends it gets it back later. Good luck. The one thing that I would suggest people also kind of keep an idea of, there's a float number, that roughly gets calculated every time there's a drawdown in silver in London. I think the last number I saw was like 170 million ounces of silver that's in London that's not accounted for in unsecured ETFs. We don't know how much of that 170 million ounces is actually available if lease rates spike to some crazy higher level than where they even are now. So yeah, it's basically, that's a signal, is keep an eye on lease rates and know that it's very, very tight. And the one thing about silver that's different than gold is that, you don't have central banks with massive amounts of silver sitting in their vaults or at the Bank of England, et cetera. I mean, there's really low lenders of last resort when it comes to silver. And so it becomes this just-in-time, type of inventory situation where people have to pay through the eye to get silver if they need it, at that moment.
So how does that situation also kind of extend to the ETFs? We've seen as well this short volume extend to PSLV and SLV. Is that, a possible symptom of that same root cause?
So the PSLV thing is one section. I'll answer that in a second. But the one thing to remember is that, recent history, the late 2010s in palladium, you had a situation where there was a legit shortage after the Volkswagen diesel scandal, where all of a sudden all these different companies switched out of platinum and into palladium, and they started using palladium in their industry, in their industrial demand sector. And palladium, NYMEX and palladium in ETFs all drew down to record low levels. And so basically when push comes to shove, the ETFs get rated as well. And so what occurred at that time is you just see this massive drawdown in the amount of physical palladium in all these transparent inventories, and you see spot price go up by 5 or 6-fold, right? So my suggestion is if that occurred in palladium, expect it to occur in silver and gold at some point. And I would suggest to anybody who has an unsecured ETF, go read the actual rules of the ETF. You'll find out, you probably don't own anything. You just simply own an unsecured proxy of this supposed to track the silver price. You get to pay for the privilege of that. So ultimately, ETFs are only really for short-term trading. Anything you stick in those, it could be taken. You just don't know. Like when it comes to making a bet, a long-term bet that can't be timed out by time decay, just stick with bullion as your foundation. And the ETFs are only for risky short-term, medium-term trades. Mm-hmm. The PSLV thing got a lot of headlines last week because there was a huge amount of shorting that's been going on. It's been ramping up. The chart looks like it was spiking up to 4 or 5 times as large as the spike from the silver squeeze originally in Q1 2021. And so I called one of my associates in the industry who I know pretty well and asked him, because he runs a fund that basically has one of the largest positions in the PSLV. So he's constantly on it, concerned about what's going on there and making sure that, he's taking care of his shareholders. What he explained to me is that essentially PSLV it's kind of like anything. When you have a brokerage account in any of these places, the different brokerages that they basically can take your shares and lend them out to high frequency trading desks, et cetera. And the high frequency traders will do whatever they're doing in order to make small, short-term profits. And that's essentially what I think is going on. You have something happening where, you have PSLV in your brokerage account, but behind the scenes, they're probably lending it out to somebody else who's using them for some other reason, for some short-term profit trade. There's a lot of other theories as to why it's occurring, but the one thing to keep an eye on with PSLV is just to know that, right now it's like 180 million ounces that's underlying the trust. Keep an eye on simply, where that number is. Is it rising or is it lowering? If it starts lowering, then I'd start getting concerned, right? But if you start seeing the actual ounces getting yanked out of that thing and changes in terms of discount premium, then I'd go deeper and get more concerned. But if the other thing, you can call your brokerage and tell them, look, stick my funds in a non-margin account so they can't lend them out to these various high frequency trading desks.
Mm-hmm. But so what is that trend at this point? Is that short volume still growing? And there's another piece to that was brought up last week, and that's this idea that Sprott hasn't released an updated, they haven't communicated to the market, and they also haven't released an updated, let's say, audit or anything like that. And from my perspective, I remember this the last time we kind of went through this, and that seems to be business as usual. Like, to me, it wasn't anything overly suspect as was being pointed out on Twitter.
Mm-hmm. Yeah, I mean, I can pull up right now. I'm going to yank it up real quick where they are in terms of ounces and the last update. Let me just check it real quick. Last update. Let's see. So they're at 180,914,264 ounces. And, if I look at the chart, it's basically gone flat, plateaued pretty much since December last year, right? And so, yeah, that's what I would key on, really. I mean, in the end, I ultimately think if Sprott does what it's designed to do, which is ultimately go out and get more ounces as you get more people buying into it, you'll end up seeing Sprott ETF be larger than SLV. I don't know by when, whether or not it's by the end of this decade or in the next. That wouldn't surprise me as Sprott becoming the largest unsecured ETF. Now, ultimately, when it comes to ETFs, I understand why a lot of people like Sprott because it's just convenient and easy. Right now, it's trading at a discount. At some point, it's gonna probably trade at an extreme premium. So yeah, then it'll be a little bit harder to rationalize that versus bullion. It really matters where you are in the world. If you are in a place in the world where it's difficult to get bullion, or you have to pay an extremely high tax rate on physical bullion, like in Europe, for instance, with the VAT there, I could see why Sprott might be attractive. But, just like with anything, there's risks. Everything has risks. If you have bullion in your house or in some depository somewhere, there's risks associated with everything. So you have to kind of calculate what you think is worth, running the risk on.
Mm-hmm. So, James, what are we seeing from the retail side as well? There seems to be this, I don't want to say, maybe apathy is the right word in the West at this point for retail appetite for gold and silver.
So there has been a good pop in gold buying of late. I mean, in terms of like the SDBullion sales, January versus February. I mean, January was a very low month, but then when February came around and we had all that ridiculous Psyop of we're gonna audit Fort Knox and all that kind of stuff. Once that started happening, you saw a massive inflow of people buying into gold. So there was a 4x in terms of the amount of ounces bought of gold in February versus January. I mean, that's a pretty stark contrast in just a matter of 30 days. On the silver side, I think where you are is you're kind of percolating between the people who understand the silver story, and we're still waiting on the actual new market entrants to come in. I still don't think you're going to get the new market entrants probably once silver starts buttressing up near 50 and passes 50, and then all of a sudden the media attention turns to silver. Once you start seeing Democrats and liberals in big cities turn to silver and say, oh, well, it's basically a metal that's good for solar power and it's good for clean energy and all those types of things. Well, they can start rationalizing why they're buying $60 silver looking for $100 silver, right? And so that's basically how it kind of works in a bull market. You have to kind of climb that wall of worry. You got to get that media attention. You got to get that story. You got to get that rationalization for why you're going into silver so strongly. Mm-hmm. And I mean, if you imagine where gold's going to be at, $60 silver, start to think of the gold silver ratio and where that might be and what the world looks like at that point. And what are the rationalizations for why we keep going higher?
You called the Fort Knox audit thing a ridiculous Psyop. Why is that?
Yeah, pretty much. I mean, it's, you can tell what the Trump administration, they like to flood the zone, quote unquote, which means that they go out and they basically spike on every conspiracy theory you can think of and kind of prod and just basically get headlines and basically get, like, for instance, the JFK files, right? Those are coming out, who knows what's going to come out of that and whether or not you're going to actually get any type of truth in that. The idea that they're going to go and audit Fort Knox it's just a canard, because in order to actually audit the gold reserves of the empire, you would have to not only go to Fort Knox, you'd have to go to 3 other places. Right, you have to go to West Point, Denver, and to New York Fed.
New York, yeah.
You'd have to have, simultaneously, you'd have to have 4 different, third-party auditor parties there. You'd have to do this, and probably it would take weeks to do it correctly. You'd have to scientifically drill holes randomly in various bars and actually have samplings and send them off to a third-party auditor that would do it. Do you think the U.S. government's going to actually do that? Do you think that the hubris of the empire that we live under would actually go through with that? Not a chance. So the idea that that's going to happen is a clown show. I think the idea that, we have supposedly 8,133 and a half tons of gold, right? The idea that we're going to ever say it's less than that is not going to happen. That's never going to happen. The only question is, when are we going to start adding to that pile, and what's going to force that to happen? We may get to a point later on in this bull market where we do that. Or we say, oh, by the way, we had this deep storage gold that we never told you about, and they drag out this story about how they got this gold from World War II in Asia. Who knows, right? So I think it's more or less just kind of flooding the zone with a bunch of headlines and attention for the administration, and just kind of hitting those parts where they know that their followers are interested in learning more about, and kind of getting their followers to really flood the zone with, oh my God, they're gonna audit the Fort Knox. Come on, sober up.
Well, that's kind of where I'd like to get your thoughts on as well. Is, we've seen all this gold and silver buying from, India, China, all of these Eastern Bloc countries. Why do you think that or where do you think that difference in attention for the metals comes from, West versus East?
It's in the cycles of their fiat currencies going to hell. I mean, think about India. They've lived under how many generations and millennia where the currencies that were traded in paper went to nothing, went to zero. Same in China. I think they went through 7 iterations of currencies last century, I believe. Tavi Costa did that research, and he told me that insight. And that is an important insight to remember, is that you have generations upon generations that have gone through cycles of their fiat currencies and their paper currencies going to nothing. And so who ended up doing right? Who ended up doing well out of that? It's people probably who held bullion or in some high-grade jewelry. And so that's why generationally in the East, it's very common to see people always having gold, always having silver. And that's just part of the way that they manage their wealth. In the West, we, like I said, we took the curriculum of gold out of business schools in the 1970s. Most Westerners are illiterate. Like if I asked someone how much gold is in an 18K piece of jewelry, they wouldn't know to divide 18 by 24 and say 75%, right? They wouldn't even know how to do that. They'll go to the We Buy Gold shops and get ripped off because they don't even understand how that market works. So that's the problem, is the lack of understanding, the lack of historical knowledge, the lack of understanding that, the US dollar at some point is going to have to be devalued because we have 100, 200 trillion in unfunded liabilities looking us square in the face. And, right now, the Trump administration is basically telling you directly on TV, like, we want the stock market to go down. We want it to go down so badly that the Federal Reserve has to start cutting rates so we can stop having to spend so much money on the interest of the debt. The Social Security, the amount of expense going out for Social Security has been ballooning. And that you can't change that unless you're going to rewrite the rules in the social contract in the United States. And that's not happening anytime soon, Jack. It's not. So the only thing they can control is the interest rate. That's essentially what they're doing. And so, if you're like a stock market bull and you're delusional and you think that somehow, like, once they start cutting rates, we'll go back to record nominal highs. I don't think so. I think gold's starting to tell you that the worms turn and that we're moving into a different cycle. And so that's why, that lowering of the S&P 500 divided by gold, I think is going to become common, and it's going to start rolling down the hill if you look at a long-term chart.
Well, and you said something very important there that I think is worth keying on. And you said stock market to new all-time nominal terms.
Right.
And that's what we have to remember, is this is a nominal high, let's say, or if you reach another high, that's a nominal high. That doesn't take into account the destruction of the purchasing power of your dollars. And I mean, Scott Bessent, the new Treasury Secretary, was talking about this detox period from the existing system the other day. So what do you think that looks like for the American public?
So for the American public, I mean, if you've done any research, Venezuela and Argentina constantly hit nominal new price highs in their stock market. That doesn't mean a damn thing because their currency is not worth all that much. And so, I guess you could smoke screen the United States by nominally propping up the stock market. And that's likely what they'll do. But what you need to do is use the denominator, and the ultimate denominator is gold. Use gold as your proxy for wealth and where things are in real value terms, because that's the one we have the longest set of data, and that's the one that doesn't destruct like everything else. And so, yeah, for the average person, I think what they're trying to do is they're getting rid of the bubble post-COVID 2020 era, this idea that you can just sit next to the fiat currency troughs and get rich and keep buying back your shares and insider selling and parachuting out of your corporation with your golden parachute. And that idea, that concept, that idea of just the gap between the wealthy and the poorest just continue to expand, and we become Brazil. I mean, we're getting close. That's essentially what they're trying to revert back toward, a country that's a little bit more sound, that actually has a manufacturing base, like a high tech one, and actually invests in its people, and actually has median wage jobs that are actually worth having for a career, that aren't just fly by night jobs where you all of a sudden get fired in like a year or two and good luck with your career type of thing. Where you actually work with a manufacturing company and you make a career of it, Jack, like it used to be here in this country when we had a better economy in terms of everyone doing better on a per capita basis.
Mm-hmm. Well, let's talk about, if you don't mind, that transition. Let's say, Trump wants to bring manufacturing back to the US, and it seems the tool to kind of really provoke that or catalyze that is these tariffs. Do you think that a lot of these tariffs are going to go through?
So I have doubts, a lot of doubts. I mean, Ray Dalio came out and said China will probably dominate us in manufacturing for the rest of his life. And Ray Dalio probably has, 15 years left. So 20 years, I don't know how old he is. But yeah, I mean, it's hard to know, right? I mean, tariffs, think about what they're talking about. They're talking about, we're going to go around the people who are underneath our, military umbrella, where basically we tell them, like, look, you're going to buy our long duration debt for 100 years out, right? And we don't care. And yeah, I'm sure that's not going to create resentment amongst people by just telling them what they're going to do, right? In order for them to have any military backing. But I understand the other side of the argument, which is like, well, these people have been getting over on us for how long, right? Mm-hmm. So you're going to have a battle here, and it's going to be waged right here in this term. And so I don't know specifically how it's going to work out. Whether or not these tariffs are going to stick or not, it's hard to know. But it is going to create a lot of what's the word? Gold likes things when things aren't sure, when things are kind of unpredictable, and that's where you're seeing the bid on gold. I mean, gold, the ultimate bid right now is the central banks, and then secondly, it would be the investing class, and the investing class is starting to realize, maybe we do have a bull market in gold here, and how high can it really go? And again, the problem is most of them are gold illiterate. So when they tell you where they think it can go, most of the times they're talking about something they don't even understand. Mm-hmm.
So Besant came out with a comment the other day talking specifically about the tariffs. And he said that this is going to be a one-time price adjustment that isn't going to be inflationary. So like, how can they possibly say that? Like, how can that make sense?
No, it doesn't. I mean, obviously, it doesn't make much sense. I mean, you basically, if you slap tariffs on something, that means the end user is going to have to pay for it, and by proxy, that would mean that the price would be the end user having to pay for it. It's not the company that's going to end up having to pay for it, right? So, I mean, you see, like, for instance, if you start slapping tariffs on car manufacturing, imported cars are going to go up precipitously, and we have a bubble in car prices as it is. So you have a situation where that doesn't make a lot of sense in terms of the concept that, if we have these tariffs and we slap on this, it's not going to cost you more. That doesn't make really any sense at all.
Mm-hmm. James, do you think that we'll ever get to a place in the U.S. where the government confiscates gold again?
No, I don't think so. That would be that doesn't. I think in a cartoon world, that's a good little trope to drag out and scare people with. But I don't think that's actually how things will go. I think ultimately what you end up having on a long-term basis is you just devalue the dollar. Historically, that's how governments who get this indebted, they generally do. I mean, they basically have to devalue the currency so much so that it makes it easier to nominally pay off what we owe. And to say, look, we didn't default. You got your checks. Nominally we adjust them to our inflation rates. Of course, the inflation rates aren't even going to come close to tracking what true inflation is. And so, by proxy, your Social Security check's just going to buy less and less over time. And so that's just how it's going to work. Obviously there'll be a couple small things here or there where there'll be, I'm just talking in general and in the big picture. Ultimately, the dollar has to devalue. That's the release valve is making the dollar devalue.
Well, and to me, it seems from a practical standpoint, that amount of gold holdings isn't going to make a dent in anything.
Well, 8,133.5 tons of gold is, in terms of, all the different countries and what they say they have in gold, it's by far the largest. But if you add up the Eurozone, actually the Eurozone's like 11,000 tons together and growing.
I meant by confiscating privately held gold within the U.S.
Yeah. So look, we have the most armed citizenry in the United States. Okay. So how many guns are there? There's more than human citizens in the country, right? So I don't know how many arms, 500 million. That's not going to happen. It's not even, the idea that, all right, so here's the other idea. Let's say they revalue gold and they say, turn in your gold at this price. People have done the research. They've already known that, that happened in 33 and like a fourth of the people actually followed suit and turned it in. And then what happened? Well, they divided the dollar further, so you turned in, you got $20.67 in paper and coinage. And then all of a sudden they turn around and say, now, surprise, it's $35 an ounce gold. So if you didn't listen to them, you kept your gold and you just kept it, squirreled away and kept your mouth numb and didn't talk to people about it. Well, then all of a sudden, you basically gained in real value terms in gold, and gold just traded in the gray market. And so, like, for instance, if you look around today, like on bullion dealer websites, you'll find a myriad of various gold coins that are sold that were issued from like 1932 back on. And all that gold, that was all the original gold that they told people to turn in with an executive order that's not even constitutional, right? So that gold that bullion dealers are trading right now is legal gold. It's basically like gold that people said, we're not turning that in. And so we're selling that stuff still today. I mean, that's the point. It's like people know the history, and I think they understand, like, if the executive order came out like that, a ton of people would never even bother. They would just, the gold would go and disappear. You wouldn't see it.
Mm-hmm. James, as we're, squarely focused on either silver and or gold, for the average investor, let's say, do you think that platinum and palladium should come into this conversation as well for the average investor?
For the average investor, unlikely. I mean, most average investors, if you look at platinum or palladium, you really have to do a lot of research and kind of build your own case for why you own some. I own a decent amount of platinum. And the reason is I just think platinum at $1,000 an ounce is going to be long-term cheap. But I don't look at platinum as thinking like, oh, platinum is going to be $2,000, $3,000 like this because of this or that reason. I don't think so. I think ultimately when you look at the gold and platinum ratio over like a long-term time frame, like 3 weeks ago at SDBullion's YouTube channel, I showed this in terms of the gold and platinum ratio. Like in 1968, when the London gold bull failed, all right, gold had been fixed at $35 an ounce for multi-decades after World War II. Platinum was free to trade. Platinum was priced like 15 times that of gold at its peak around that time. And now we're at a situation where gold is trading 3 times 1 ounce of platinum, right? So think about that. In a matter of, some odd, I don't know, what is that, 54 years or so, you have a situation where it went from 15 to 1 platinum to gold to now 3 to 1 gold to platinum, right? So if you think in terms of long-term timescales, you start to look at platinum and you think, man, that's pretty cheap versus gold. Mm-hmm. But if you do that, you better at least have a long-term understanding of what you're getting into, right? If you're trying to trade that off proxy, off that ratio, you could have a situation where gold goes 15 times 1 to platinum. It was at 15 to 1 there. If we're going to go through a monetary reset and gold gets the massive premium bid, you could have a situation where that ratio even gaps higher. Mm-hmm. Like you think 3 to 1's high, it could go 9 to 1, 7 to 1. That wouldn't surprise me in this time frame. And at that point, you start to look at it and you're like, well, gold's pretty expensive compared to platinum, and you'd probably start allocating more toward platinum. And you have to do the research and understand what platinum is, why it's different from, the fact that it's more scarce in terms of above ground supply, and it's used in various applications that gold and silver cannot be used in because it's so, just the properties of the metal itself and the melt point of it, it's used in places where gold wouldn't really work. So you have to kind of do a deep dive in understanding what are the reasons why you see platinum as a value if you were to allocate anything toward it.
Mm-hmm. James, what do you think is really worth paying attention for precious metals investors right now? As you look, let's say out to the end of 2025, what do you think is most key to keep in mind?
I think to keep in mind is, first and foremost, like, what is your prudent allocation into liquid net worth? If you look back, from 1968 till now, in general, if you go back and look at gold versus the S&P 500 and the bond market and liquid net worth, it's worked out to the best risk reward ratio has basically been 20% gold in bullion versus the S&P 500 and bonds throughout that entire time frame. Mm-hmm. But what I'm suggesting is that we're going into a place where gold is going to reassert itself above those two other asset categories. So if you're aggressive and you're studied and you have a cool hand and you have a long-term perspective, you would allocate 20% of your liquid net worth into gold bullion, knowing that it's probably going to grow to 30-40% of your liquid net worth. And at some point, you're probably going to want to draw down some of those gains in gold and start moving into other asset classes. Mm-hmm. So like anything in cycles, in long-term cycles, certain asset classes start to overvalue themselves and they start to go into places where they're overvalued versus other asset classes. So you have to kind of keep an eye on other asset classes and where you think those transitions will start to occur and start reallocating when you think you're kind of getting near those time frames. Mm-hmm. So you kind of keep in mind, like, okay, S&P 500 versus gold 1-to-1, that is inevitable. I think if you look at the 2011 low spike, got down to like 0.6 or 7, I think that's going to happen as well. And so those are kind of key things that I keep in my mind on a long-term basis for understanding when. Look, I'm waiting until the youngest generations start spitting on stocks. If you go back to the late 1970s, people literally spat on stocks. They thought people that sold stocks were scum, right? They thought that stocks were a place for the dead, right? And that was the generational tipping point where all of a sudden, if that is the attitude, you start looking at stocks and you start thinking, well, I'm going to start buying some of the most, great corporations in the United States that I know will be around for the next 10, 20 years. And I'm going to start taking positions in those because when anything, as an investor, you just basically look around and you're like, well, everything in the United States, it's basically set up for the stock market. That's generally what it's set up for. And so, for you to sit there and start spitting on stocks is kind of short-sighted. You have to understand that these types of things, these types of cycles go through, and then eventually we get out of them and we go back into a spring or summer transition and stocks start to outperform gold. Mm-hmm. So you just kind of have to keep the longer-term perspective and know that nothing goes the same way all the time. It goes down and it probably overdoes it, and then it goes back into another cycle, into another way. And so, that's what I keep an eye on: the unfunded liabilities, the cultural situation. When are we going to reset the societal contract? How is that going to go down politically? These are all things that are big picture questions, and they're much further out than 2025. They're out toward 2035. And, how is this going to be, how are we going to come to terms with where we are as far as not only a culture, but in a sense of a world and how we trade and how we treat and handle one another.
Mm-hmm. And how, if there's space for other empires, other currencies, this transition to a multipolar world is going to be something that A, is going to take time, but B, is going to be a big adjustment. And I think those of us that are in this community understand a lot more of that.
Yeah, this is not an overnight thing. This is not a sprint. It's a marathon, right? And in the marathon, you have to kind of pace yourself, right? And understand this doesn't happen like that. I know there's a lot of people that think, we could get in a situation where overnight gold gets revalued. Yeah, maybe, but maybe not. So, keep in mind that that's unlikely. I think ultimately we just go through a massive secular bull that goes on for a long time. And, the amount of change from here to there is going to be huge, the amount of things that come along. But on the long-term cycle, I just think when you look at the arithmetic and the situation where we are, gold has a lot to go. And 3,000 again in the future is going to be looked at as cheap, I think, ultimately.
Mm-hmm. Excellent, James. Well, I appreciate you shining light on a lot of these different topics for us today. Of course, you're an excellent follow on X or Twitter @JamesHenry and. SDBullion.com, and of course the SDBullion YouTube page as well, right?
Yeah, Tom, I appreciate having me on. It was always a pleasure, bud.
It is always a pleasure, James. Thank you very much. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.